Hey, good afternoon, everyone. It is Thursday, so big USDA report today. Let's just jump right into it and take a look at what that report told us, and look at what that may have to do with carryouts moving forward. And then we'll look at the price action. Okay. Obviously, most of you probably know the price action was pretty bullish for all three grains. So let's focus in on corn here first because I think it's the one talking the loudest. So here's what the USDA said, and here's September report, here's the October report. They're side by side so you can see them, okay? So the USDA decreased yield by 0.8 of a bushel. This is interesting. Um, they actually decreased beginning stocks, which means that they lost some of that inventory that they said that they had at September 30. And so they decreased that. So decreased production is down, total supply is down, and then they decreased demand by just a little bit. Now, what I think is really interesting is what they didn't do here, which is they could have, and I don't think anybody would have second guessed them for a second. They could have easily dropped demand as much as they dropped supply. They could have easily taken this down enough to just offset it and maintain the carryout at 2221. But the USDA didn't. And I think this is just my opinion here, okay? I don't have any facts to back this up other than just what I'm reading and trying to see between the lines. What I think that the USDA did today and what got the traders interested in buying it is they signaled that demand is present. They didn't signal that it's going to get lower, because if they were going to send that signal, they would have dropped it even with demand, or they would have dropped it just a little bit more. So if the USDA thought that that we needed lower prices in order to create demand, then that's what they would have done. They would have increased this carryout by decreasing demand more than supply and sent that signal. And they didn't, which sent a covering signal in, and that's why you saw bull spreads move. And this followed a very strong weekend basis where basis levels bumped significantly all across the space. So my read on this is the USDA is saying, whoa, wait just a minute. We don't know what we have. So now let's play some games here and let's look at what the USDA said. Okay, this is what they said. This is a little difference here because of rounding errors, right? But the core here is the same. Now, what I want to focus in on is the yield. So I think that our yield is overstated at 173, and here is why. Because if you want to compare good to excellent ratings, which is what the majority of traders are doing, they are comparing good to excellent ratings on all of the planted acres. But last year, what we did in order to get a 173.3 is we cut the harvested acres down, or we took all the really bad stuff out of the average, right? That's a really good way to raise your test score, is if you throw away all your bad grades. So that's what happened when we took all the acres out. We've talked about this before, but our yield last year when you put those back in was closer to a 169. So if you assume that is the case and we're off of that, then our yield is probably closer to a 164, 167. And then if you take into account the windstorm that's supposed to be causing some damage, maybe we're as low as a 164 or maybe a little bit less. And if you hold everything else constant, then our carryout is back down under 10 at 133. And I think that the USDA, they weren't ready to go here, right? Because there's not enough data. So I'm not being critical of them at all. I think that they're giving us a warning shot that says, hey, this may not be what we previously thought. This crop may be a little bit smaller, and or demand might be here stronger than more present than we think it was. So if you looked at what they said with the CONAB or the South American stuff yesterday, what they said that their corn exports were almost 500 million bushels less than the prior year. But what's interesting is that their carryout shrunk. So the assumption is that less exports equals less demand. But if your carryout shrinks, what that's telling you is that you can't export what you don't have. So you have to keep it internally. Now, here, could this be the same? That our export picture isn't bad because demand's not present, but it's bad because our beginning stocks aren't what they once thought that they were. So so the USDA is sending us some signals here that maybe we're low enough, maybe we need to be careful and not generate more demand because we may not have enough depending on both the supply and the demand factors at play. How the war and escalation and hostilities and tensions globally plays into that, I don't know. But my sense is that that's more bullish than bearish for food because you have to have it to fight a war. You can't risk depleting your stockpiles, and if demand and exports are lower in here and in South America, then that means somebody is running really low on food, and that's not bearish food prices. So I think the USDA is saying, hey, we're probably somewhere between these two things. Don't go run out and say, hey, we think our carryout's down here. I don't know that yet, but that's my sense, and I think the USDA started to send that message today. So I wouldn't be surprised to see corn put some premium back on here because I think it's got to, whether it does it now or here shortly. But I definitely am not really interested in being a seller of the corn market right down here because I think that the odds favor this direction over here more so than they would favor this direction over here based on what we are seeing and what we're hearing. Anything's possible, and obviously we don't speak for the USDA. We're trying to read between the lines, but that is our sense and how we're reading it. No different in beans. They did the same thing. They lowered the yield, right? They lowered it 0.5 of a bushel. They maintained acreage, and then they lowered demand just enough to hold steady. So unlike corn, where they lowered, actually shrunk the carryout, they held beans, but that's because beans are already super tight. So what happens if the same impact as corn is, right? If we just drop another 1.6 million or 1.6 bushel an acre off, and maybe they're off on beginning stocks just a little bit, we're really tight. We have to ration beans. There's no question about it. You gotta go because our supplies are just too tight. So I think beans are super, super bullish. That's why they were up significantly today. I think corn is getting really bullish. I think technically it looks the best, but I think that's why. Okay, now let's jump right in here to the charts and take a look at what we did. So this is soybeans. We've been talking about this for several weeks. We think that this move is overextended. We think it's a wave 2. We think this is all a correction off of this low back here. Let me readjust this map or this chart so you can see it. We don't think that this is a downtrend. We think it's this counter trend. Why do we think that? Well, let's just go through our analysis, okay? First of all, are we contained within parallel lines? From here to here, to here to here. Answer, yes, we're contained within parallel lines. Second piece of information, are we holding Fibonacci support and resistance? Answer, absolutely. This is 61.8% of that move contained within parallel lines in a wave 2 position with almost identical proportionality between the A and C waves, and time and price and slope. Everything here looks really, really good. And then today's action was significant because we finally took out some highs, right? And we made a baby low here by 1/4 cent. We fully engulfed yesterday and the previous 9 days closes. 1, 2, 3, 4, 5, 6, 7, 8, 9 closes. We took out 1, 2, 3, 4 full days, 4, 5, 6, 7, 8 full days ranges, and started to attack this level here. We kind of ran out of steam right towards the end of the day. I don't think that matters. I think that signal is what it is, and we're going to go up and out. So what we don't want to see is as a violation of this low. I think beans are pretty simple from this point out. That's a big signal, way bigger than any of the other signals that we've had. I haven't gone back to fact check this, but I think that's the biggest reversal bar that we've had since the August of 2020 report came out. I think that's the significance of this one. This is even more significant than the June 30 day because we didn't engulf nearly as many days, and we didn't actually, this was a continuation of an already in place reversal pattern, and it wasn't in a wave two. So here we go. I think that that's pretty significant and something that we want to be aware of. So what does that mean for marketing? Well, that means that your cash sales that you have, you need to be getting re-ownership on. Because if that count is right, then this high is gone. It's going to get blown out of the water, and we're going higher on beans if that count is accurate. So you should be buying calls. I think you should buy calls out into the March or May timeframes, and you should just hold them. How aggressive you want to be is up to you, right? That's an individual choice. If you want to go at the money, they're pretty expensive. If you want to go out of the money, it's not as bad. You can buy futures and buy puts. But regardless of what it is, I think that beans have got to go higher based on everything we're seeing, and we finally have a really nice sell signal or confirmation signal here. Now, do I think we're out of the woods to the downside? This is a nice start. We got to get up above our hedge line, and I want to see us up above that high right here at 1305 on a closing basis, because that's where we fell out of bed the last time. A move above that, I think, is super bullish. But from just a position, we've been talking a lot about our algorithm and how it's developed and changed. From a position standpoint, we need to get delta bought here because the upside is open. Okay, let's take a look at corn. Corn didn't quite have as exuberant of a day as beans, but it did have a good day, and we did make a baby low here. We fully engulfed the last 2 days, 3 days, and we almost squeaked out a new high here. I really like the setup back up into the daily cloud, crossing over from mid-range on our oscillators. Corn above $5 needs to be bought. I don't think there's any question about that. From a technical perspective, this chart looks really good, and it's going to look fantastic with a move up above 506, 507. How far does it propel it? I don't know. If beans really get going, corn's not going lower, and if those lower carryouts start to get to weighing on traders' minds, then we're going higher on these markets. There's no question about it if those carryouts are that low. So what should you do from a marketing perspective? We've been long 470 puts, perfectly happy there. I wouldn't even mind moving out and getting more time under those, because I think that this signal is pretty significant, and the more highs we take out, the more significant it becomes in our opinion. So long delta, long your crop, long if you've sold your cash, you want to get long call ownership on. And again, if you're in that situation, how much premium you pay is what you could lose. So you want to choose a strike and a time frame that works for you, but regardless, you need to own calls into that market, because it's to a point where the downside just doesn't really have the risk or the teeth in it that it once maybe did. So we'll see how the traders continue to beat it around, but 482 down to, call it 475, this low, that's where you want to risk that to, and not overthink it. Okay, Kansas City wheat, the market that just gets pulverized every single day and just will not stop. We like Kansas City wheat. I mean, hey, it got some bearish news on the 31st, and today they confirmed it. It's the first time we've had bearish news, and the market shrugged it off and went on higher. A lot of times it's darkest right before the dawn, and when you start to get 13s and bullish divergences across the board, and now you have a bullish reaction to a bearish report, it's exactly what you want to see before a move higher. I think that if corn goes higher, I think wheat's going to start to reflect its tighter global fundamentals as opposed to just its domestic ones. And the USDA has been really clear. It will change its mind, and it will lose bushels that it had previously found, because it's not because they're wrong or lying or anything else. It's because they don't have good data either. They're only as good as the information that they have, and when they get new stuff, they have to update their numbers and bring numbers back in line. So I wouldn't be a seller of wheat down here. I know that's hard to say or hard to take, because we've been long for too long, and and some of these trades look pretty nasty. But from a risk perspective, there's no question what today brings, and you want to be open and long. Definitely, if we get back above 692 or 7, which would be that high and that low right there, 703 to 692, above that, you want to own it because you just don't know how far the short covering will pull it. Last thing on wheat. A lot of people are like, well, if the fundamentals aren't that bad and it's not that bearish, then why are we just pummeling it? Well, I think it's a spread with interest rates. I think that the implication is that higher interest rates will pound the wheat market hardest because that's anti-inflationary, and so this is going to be one of the first markets to deflate. I think that trade is prevalent among funds and institutions today, and it'll take some actual grain fundamentals in order to pull it higher, which higher corn will do that, in my opinion, as will weather and the risk of a growing crop moving forward. So, and then if inflation does start to kick back up and really rear its head, then look out above because wheat will put all that premium back on. All right, that's 16 minutes. It's kind of a long video, but remember, there is always risk trading futures and options, and you should only do so in light of your own financial condition. We will be back with you tomorrow at the close to see where traders close this stuff out, and if they put any pressure and undo today's strength, that's bad. But if we get follow through to it, then I think you just have to have re-ownership of some kind to your risk tolerance level. If you need help with that, please call us. We're more than happy to talk you through it, walk you through it, help you get positioned the right way. Hope you guys have a terrific night. We'll talk to you tomorrow.